Hey everybody, welcome to the live stream. I'm Michelle. If you're checking in again, welcome back. If you're new to the channel, this is the channel all about options trading, selling puts, selling covered calls. Why? To create yourself income on a regular basis. Forget about the old school, buy some stock, wait and pray and hope that it goes up and then sell it and then make money. No, like you want to create yourself cash flow on a regular basis that you can live on, or it can help sustain your lifestyle, or it can, add some extra side money to whatever income that you already have. So that's what we're talking about. This live stream is a great opportunity where we go through real trades, go through your questions live, and it gives you the opportunity to be a better trader. And you don't have to have any experience. Also, I've gotten some questions, I'm new at this, how do I start, that kind of thing. If you're new at trading, or let's say maybe you never even invested in stocks before, that's totally okay. Listen, we all start from somewhere. It doesn't matter whether it's trading or something else. Like, we're all starting a new thing at zero, right? I highly suggest go through the videos on this channel. There's tons of great videos where I talk about all about options and how to find trades, how to manage trades. What does it mean to sell a put? What does it mean to sell a covered call? How do I choose strike prices? How do I choose expiration dates? I have live events every so often. I'm going to plan another live event coming soon. So if you're not already on my distribution list, make sure you're on there. It's totally free. Just go to my website, cressivo.com, and join what's called the Inner Circle. So that's my distribution list for when I launch new events. So anyway, let's talk about options. Let's get started. I want to go through a couple things, and this is important. I think it was today, I put up a video about leveraged ETFs. And I want to talk about how the math works. And it's not in a boring way. You don't have to be some like MIT graduate or super good in math or that kind of thing. A lot of people don't recognize exactly how math works when it comes to trading. So I'm going to break it down super simple. I'm going to start there, and then I'm going to go through your questions and comments as well as the account that we're looking at. We're always paying attention to realized gain. That's what I was looking at before I pull this up. And I have a position in my account here, TSLL, right? So this is something that I got assigned on Friday last week. And this is a leveraged ETF. So it's a great example, and I want to walk through exactly how you want to look at that. So TSLL is a leveraged Tesla. But if you watched my video that dropped today, leveraged ETFs are not necessarily just leveraged holding the underlying, right? It's not just, extra Tesla shares or leveraged Tesla shares. No, there are a lot of like swaps and derivatives and things that you probably don't even understand that are intended to hit like 2x or 3x of the underlying. And here's the thing, they rebalance every day. And that's the math that I want to walk through briefly on this live stream, because I want to make sure you guys understand it, because oftentimes when I go through this with people afterward, they're like, oh my gosh, I never realized that would happen that way. So let's say if you own just Tesla shares, right? Or let's say you look at any math, like something goes up 30%, and TSLL today, by the way, this is a great example. It's down 28%. So this is a great example to walk through. So let's say something goes up 30% and then it goes down 30%. Most people will intuitively think, okay, I'm flat. I'm like where I started. I went up 30%, I went down 30%, and now I'm where I started. That is not the case with leveraged ETFs. And I'm going to explain to you why that is. They reset every day. So their intention is to use a bunch of stuff in there. Again, not just the leveraged underlying, but all kinds of other derivative type things with counterparties that you don't even know who they are or how reliable they are, that sort of thing. And it's intended to hit like I don't even know, is TSLL two times the Tesla or 3? So it's 2 times. So it's meant to hit 2 times. What that means is if Tesla, let's say, goes up 10%, this fund is meant to go up 20%, right? Because it's intended to hit 2 times the underlying. If Tesla goes down 10%, this fund is intended to go down 20%, 2 times, right? However, because of the way the math works, I'm just going to use a regular number. I'm going to say you start with $5,000, right? And let's say you go up 30%. So I'm going to do times 1.3. So you go up, you have $5,000 and that thing goes up 30%. Now you have $6,500, right? Because it's a 30% increase. Now, let's say you go down 30%. This is where I lose people. This is where most people think, okay, I go back to 5,000. But let's look at the math together. If I'm going down 30%, I'm going to multiply that times 0.7, right? Because, 100% less 30% is 70%. I'm at 4,550. So if you start at 5,000 and you go up 30% and you're at 6,500 and then you go down 30%, you're not where you started. You're below. You're like almost $500 below. So this is why leveraged ETFs are not really meant, certainly not meant to like trade a wheel type of strategy. I'm going to sell it. You could do it. I'm not saying you can't do it, but they're really not meant for that. Sell a put, and then if it goes down, I'm going to buy the shares, then I'm going to sell a covered call, and if it goes down more, I'm going to sell another put. That works really, really good on regular stocks, businesses, companies, and even ETFs. Like ETFs, a regular ETF, not a leveraged ETF, but a regular ETF, which is like a basket of a bunch of things, right? You can have like a technology ETF or an S&P ETF, or there's a whole bunch of different types of things, semiconductor ETF, energy type ETF, whatever. The wheel strategy, selling puts and then covered calls, if and when you get assigned, works great on those. However, with leverage ETFs, it works differently because of the way this math works. So I want to make sure you guys understand that. The part of the attraction of a leverage ETF is a couple things. Number one, people see like, oh my gosh, I could make like, 300% per year. And then they couple that with, oh my gosh, it's only $10 for a ticker, and it's Tesla, and Tesla's 400, but I could trade it like here for $10. You can use these leverage ETFs to make like short-term like bursts of cash, but it's very, very risky. It's very, very high risk. A lot of things are like risk versus reward, right? Like there's no free lunch, you might say. And that's something that you want to be conscious of. I'm not saying not to use it. I've traded them once in a while myself, not often though, because I think they suck. And I think that they were created to really bamboozle investors. I think they were created to like entice investors to like dump infuse a whole ton of money. And people just, first of all, they don't have any idea or any understanding on what's inside of that, right? When you're trading a regular stock, it's a business, right? So let's say you sell a put on Disney, Walt Disney, right? And you have to buy the shares of Disney. You own a fraction of the company, and you can see like, okay, who's running the company and who's on their board of directors and what do they do and how much money do they make and what kind of challenges do they have and that kind of thing. So it's very, very transparent, right? They have to do quarterly earnings, right? To let people know sort of, different numbers and that sort of thing. So it's very transparent. And when you trade leverage ETFs, you don't have that transparency. And so I wanted to make sure that I went through that with you guys. Let me know in the comments if you guys have questions. Listen, this is a great opportunity. I work with a handful of people one-on-one, and I charge a lot of money for that. And so these sessions are a great opportunity if, like, let's say you can't afford it or it's just not on your radar at the moment, you could take advantage of my knowledge, right? I'm here to help. I've been trading 29 years, and I've done lots of things that really worked well and some things that haven't worked well. And I've used that experience to help guide people throughout their journey with the intention of, creating income, cash flow. The whole world is about cash flow. It's not about some, nonsense like I got my statement and I bought some Bitcoin and I put $10,000 and now it's up to $20,000. It doesn't mean anything when it's on a piece of paper. You can't spend that. So that's a broken system. So the step one is identifying, like, oh my gosh, like everything I thought of in the stock market is kind of like not really that accurate, and then recognizing, okay, well, I don't know, options sounds kind of cool. Like how does that work? Let me learn a little bit more about that. And then you jump in and learn. And there is a bit of a learning curve. It takes a little bit of time to wrap your head around it because it's something new. But once you learn, man, and once it clicks for the whole rest of your life. And it's not about making money for a week or a month or a year even. It's about changing your entire lifestyle. So that's what kind of like, I don't know, psychs me up to help people do that, because I've seen what it can do. And yeah, so there's that. David, building the bankroll is the big challenge at the moment for me. I'm doing small puts on small stocks. Love selling puts. Yeah, so here's the thing about selling options. It works regardless of whether you have a big account or a small account. Warren Buffett said it best himself, and I had this in another video recently. It's actually a disadvantage to be really, really big because it's harder to get in and out of trades. And so I would encourage you, if you have a small account, like embrace that. That's an advantage. And that just means that we have to pick, tickers that have a lower price. We can use this. We can just go into like this stock scanner as an example. And let's say I have a $10,000 account, just as an example. And I want to just, let's see. Now, I'm going to change some of the way this page looks. But right now, what it does is it kind of gives me like my maximum. Let's say I just want to look at like $10, like nothing more than $10. Or let's go a little bit higher. Let's see. We can just manipulate this. Let's say I want to look at, a ticker that's not more than $14, just as an example. I'm just going to leave all of this kind of the same, and I'm gonna run a scan 1 to 10 days. That's kind of like the sweet spot, 1 week plus or minus, that kind of thing. And let's just see what pops up, and it gives us like, just a starting point of what should I trade? And I would encourage you to trade something like the biggest decision is the ticker that you're trading. That's the biggest decision, because first of all, we don't know if it's going to go up or down or whatever. And let's say it goes down, you want to be committed to be able to sell another put if that goes down. You don't want it to be like, okay, I'm seeing this ABC stock and the numbers look great, not know anything about the company, and then you trade it and then that ticker goes down, and then you're like, oh my gosh, I don't want to put more money into it. Then you started the trade wrong to begin with. So you want to make sure that you start with the right ticker. I always encourage people, start with a ticker that you're familiar with, right? So like, I don't know, like, use a company that, and it depends on your budget. So like a well-known, like Apple. Like I've always traded Apple over Microsoft. I'm a big Apple person, not really a Microsoft person. I never really traded McDonald's as an example because ethically I think that company is like really, really bad for people, like super bad for people. So ethically it just doesn't align with, where I want to make money. My decisions don't necessarily have to be your decisions, but I encourage you to start with something right? So this kind of gives us like a starting ground. So as I skim through, I see, okay, Mara, like I'm a big Bitcoin believer, and I've been trading Mara probably for like 10 years or something, I don't know. I'm not trading it now, but I have traded lots of times in the past. So it's something like, okay, that's recognizable to me. Well, now let me look at it, right? So and it helps you understand, okay, well, if you were to sell a put first, what kind of, expiration date, like as an example, July 31, what kind of delta, what kind of strike price would I be looking at? How much capital do I need, right? And then most importantly, if that ticker goes down, you want to have a plan in place ahead of time. Okay, if it goes down, I'm going to look at selling a $9 strike afterward. So it kind of like helps you walk through these things so you have a roadmap. It's like, listen, I did this like 3 times not long ago, LA to New York. Like 3 times in my little Porsche 911 with my daughter and 2 dogs and a bunch of shit in the car. And it's like I wouldn't hop in the car and not have some sort of an idea. Okay, I'm going to drive from New York City to, I don't know, Ohio or whatever, wherever my first stop was. And here's the city I'm going to stop at. Here's how long it's going to take me. Here's probably like the hotel I'm going to stay at, that kind of thing. Like if you don't just jump in the car and just go, right, without any idea of how you're going to get to where you want to go. This is the same thing. So these tools help you do that, right? So yeah, anyway, hope that helps, David. Nice to see you also. Always a new subscriber, so that's really good. Think $685 could be used for selling puts. I always suggest, it's hard to say like, okay, what dollar amount is there. First of all, number one, different broker dealers have different requirements. So some typically a broker dealer might require like $2,000 to start. I think $2,000 or $5,000 is like the best initial starting ground. And then because you don't want to like go in too small, and then the worst thing that can happen is you sell it one put because you don't have that much money, and it ties up all your cash, and then it goes down, then you kind of like have this bad taste in your mouth for options. I think I would wait until at least maybe you have $2,000 or something. But in the meantime, you can paper trade. I'm not a big fan of paper trading, I'm going to be honest with you, because of a couple reasons. Number one, it's not really real money, so you will think differently, and then also your fills are very different when you paper trade versus like a real live account. But it does like lets you practice, get your feet wet, make mistakes, that kind of thing. So, and you can set up a paper trading account for free at any broker dealer. So I would highly suggest something like that. All right, let's see. Joy says, can you go over how earnings impact our trades? Should we place trades or not? Earnings is probably like one of my favorite times of the year. Not really of the year, because it's quarterly anyway. Here's how earnings works, right? So like every quarter, a publicly traded company will declare their earnings. And it's the opportunity for the company to, talk to their shareholders and talk about everything that's going on. Hey, we made this much money this quarter. We expect this much money next quarter. Here's our revenue. Here's our expenses. Here's our profit. Here's some, challenges that we're facing, all that kind of stuff. And because earnings is like an uncertain event, it adds volatility. So volatility is kind of like how much swing something has. So it either goes up a lot or maybe it goes down a lot. And sometimes, if we expect like a lot of volatility, we don't know the direction it's going to go. Like we might say, hey, it's probably going to go up a lot, or it might also go down a lot. So with volatility, when volatility is higher, your premium is higher. That means that you're getting paid more for the risk that you're taking, right? So let's say if it's not earnings and you're taking that same risk and you're selling like, I don't know, $100 put on something, your premium is going to be less when it's not earnings and when the volatility is lower. And so it does a couple things. It means this. It means that somebody who's buying options is going to pay a lot of money. So they're going to pay like a surcharge, right? More than probably what they should be paying because of the volatility. And when we're selling those options and we're collecting premium, we are collecting that surcharge. So I think this is probably, I would say that there's a few like amazing things that I've put in this app. The margin configuration and is one of them, and not just margin, by the way, but the simulator page. If my stuff goes down, 13%, or if this goes down 7% and this goes down, 23%, where does that put my account? That is like off the fucking hook, first of all. But the second thing that's like off the hook is this earnings edge module. It's my favorite part. So you could do it a couple different ways, right? This page, I'm going to get rid of. A lot of this stuff is a work in progress, and I don't necessarily scrap it because, I don't know, it's kind of like cleaning my closet. I got a bunch of old clothes and I don't really wear them anymore, but sometimes I feel like, I'm just going to keep them there just in case. This is kind of the same thing. This page I don't really look at. So just don't look at this. I might scrap it at some point. I've just been not prompted to do so. I look at custom ticker and I look at screener. So custom ticker, if you already have a ticker in mind and that has earnings coming up, you can plug it in there. But let's say you don't have anything in mind and you're like looking for an opportunity, like to make some money. You pull up the screener and you run a scan. And what this is doing, because listen, this is why it's like one of the best things that I've created, because it takes everything that's been in my head and like quantifies it, because everything is mathematical. Listen, the whole world is mathematical. And with computers and with AI, we can make that more efficient. And so what this tool is doing is saying a couple things. First of all, tell me all the companies that have their earnings coming up. Number one, that's the easy part, right? So all the companies that have earnings coming up over the next 2 weeks. And then also on top of that, tell me what happened over the last 5 years. Because when we look at history, it helps us understand what might happen in the future. I mean, everybody's heard that kind of like old adage, history repeats itself. I mean, I don't believe in a lot of those like cliches, so to say, but that is a pretty valid one. History repeats itself, and it gives us an idea of likelihoods. Listen, nothing is 100%. Like trading's not 100%. The world is not 100%. Relationships are not 100%. Nothing is ever 100%. There's no black and white ever. There's always shades of gray, right? Everywhere. Life, trading, everything. So what we want to do is we want to kind of get a sense of likelihoods, like for example, okay, I'm going to give you an example. This is actually a great example, so pay attention. We might go a little bit more than 30 minutes today because I got a lot of stuff I want to say. I lived in the Virgin Islands for a very long time, 10 years or something. I lived there full time for maybe 5 years and then off and on for 5 years. And then ultimately I sold my property a couple years ago. Anyway, long story short, the Virgin Islands, if you don't know, is in the Caribbean, right? It's a very hurricane-prone place. And because of that, it's important to have hurricane insurance. Why? Because hurricanes happen a lot, right? Now a hurricane, I bought my place in 2013, I think it was. And a hurricane at that time had not happened for a long time, right? But still, if a hurricane happens, it can be catastrophic, right? You could lose your whole house, blow away. And it's a hurricane, like geographically place. And so 2017 comes. Now, I always had homeowners insurance because I always had a mortgage. So if you have a mortgage, they require you to have homeowners insurance. So I always had that. 2017 comes, and what happens? Hurricane Irma, Category 5, September, I forget when that happened, September something of 2017, right? 2 weeks later, and it hit St. John, by the way. 2 weeks later, Hurricane Irma, another Category 5 hurricane. Now, it had been a long time that a hurricane hit, but now two of them hit Category 5. It was like the strongest, 220 mile an hour winds, something like that. Houses were decimated. And a friend of mine, a very dear friend of mine, he had paid off his mortgage. Like, I'm laughing, but it's really not funny. It's not, and I don't mean to sound insincere. He had paid off his mortgage a couple of months prior to September of 2017, and he took off his homeowner's insurance because it's expensive. So I think in the Virgin Islands I was paying like $12,000 a year in homeowner's insurance, including hurricane insurance, and comparatively, prior to that I was living in Connecticut and I might have paid $500 a year in homeowners. So it was much more expensive, but it's because your risk is big, right? So he took off his homeowner's insurance. What happens? A hurricane hits. He's got like a $3 million house or whatever, and his house is decimated. Now, instead of spending $12,000 or $15,000 or even $20,000 a year to insure $2 million or $3 million, he made the wrong choice. So what we look at is likelihoods, right? So how likely is this going to happen? And then not just how likely, but what's the ramification if it happens? Like how intense will that be? So we look at that. So we pull up a screener. Now this is showing us over the past 5 years the best trades, and I put how would I say, like logic, I forget the word I'm trying to, oh my gosh, I'm trying to think of the word off the top of my head. Proprietary. I put proprietary logic that I built. This is logic that I used, but I never really quantified in an actual application before. And parts of that logic is, let's look at the last 5 years. And over the last 5 years, how many times did that thing go up, the stock, after the earnings, and how many times did it go down? Because if it goes down more, then if it goes up more, then it goes down. That's a good thing, right? Because history repeats itself, and it might make it more likely that it's going to go up. So that's in there. And then I'm just going to pick the top one, Bloom Energy. I don't know. I picked this the other day. Maybe I should choose it. Let me choose a different one, actually, because I did this one the other day. And I want to show you guys like lots of different things. Let me just see if any of these sound familiar to me. Expedia. I don't know. EXPE, I think, is Expedia. Let me just double check. EXPE stock. Yeah, so that's Expedia. Okay, so then it tells me, okay, earnings is August 5th. This is a long-winded answer to your question, by the way, Joy, but it is very, very important. So it shows me, okay, it went up 11 times over the past 9 times going down. So that's advantageous, right? A couple of other things that is important to look at. The market anticipates this stock to either go up or down almost 12%. So that's volatile, right? Historically, it's only gone up or down like 9.5%. It's just the mathematics of it. So I'm fetching all the stuff, and I'm putting it all in one place for you to look at. When this is positive, this is good. It gives you an edge because the implied move is expected to be bigger than where it has been historically, meaning that you can take in more premium for the risk that you're taking, right? And then it gives you like a suggested trade. Okay, so here's the thing, and again, this is likelihoods, right? So if let's say it's going to go down perhaps 11.71%, if I sell a put, I want to use a strike price underneath that 11.71%. So this is giving it to you so you don't have to calculate it for yourself. So as an example, okay, here's an example. Sell the August 7th, 225, because earnings is August 5th. So when you want to sell a trade like a little bit after, the 225 put, it's paying about $480. Here's how much capital I need for the trade. Here's how much premium I'm going to make. Here's my strike price, my expiration date. There's my annualized rate of return. So it would have to drop lower in order for you to have to buy those shares. So that's like a safety net. So what we're doing when we're trading is we're using like safety nets. Like, okay, I'm okay buying the shares, but if I have a choice, I'd rather not buy the shares, right? I'd rather just take the cash and just run away. It's kind of like the insurance company who insures my car, right? And they're hoping that they just charge me a premium and then I don't have an accident, so they don't have to pay a claim. This is the same thing, right? It's very, very similar to a car insurance scenario. So you can use this app to find really good opportunities. Or if something's coming up, earnings, you could just type in the ticker right here, and then just don't look at that first one. It's just not all that valuable. So anyway, in answer to your question, your specific question, should we place trades or not? I think why not? But you have to do it in a smart way. So you want to look through this and see the best opportunity. Now that said, just try to trade a handful of things. Like it's hard to keep track of 20 things. 5 is always a good number. I trade 5 things. It's always best if there's a little bit of non-correlation between them. So in other words, not all, let's say AI stocks as an example, because if one goes up, they're all going to go up. One goes down, they're all going to go down. So non-correlated assets is helpful. ET Phone Home. Have you ever done a cash secured put on the index? So SPY is my least favorite ever. So that's like the S&P 500 index. The volatility is really, really low. Let's look at it together. So let's say I'm going to go here into the short puts. I'm going to look at my live data. I'm going to type in SPY. And I'm going to choose an expiration date of, I don't know, let me just go out, I don't know, 29th. And I want to be conservative, right? I want low delta. I want to be super conservative. Well, first of all, SPY is super expensive, $700 a share. So first of all, $700 a share, if you're going to sell a put, you're committing $70,000 on one trade, number one. Now, people think that that's safe, but no, it's not safe, because look at my annualized rate of return. The premium, $91, maybe you might say, wow, that's kind of a lot of money, but you're putting up $71,000 to get that $90. So when you annualize your number out, and by the way, if you're selling puts and you're not calculating your annualized rate of return before you make the trade, you are making like the most basic, unnecessary mistake ever. I see so many people that do that, and they should not. Even people that I've taught trading before, they should not do that. It takes literally like you can use my app, or you could just use a calculator if you want and calculate it yourself. It takes like, I don't know, not even 60 seconds to calculate it, because if you calculate it and you look at it and like, oh my gosh, do I want to make 7% on my money? Heck no, I don't want to make 7%. That's too low. That's way too low. So index puts, no, I don't really like them. I have done them before, QQQ sometimes, but the volatility is really low, so the premium always kind of stinks. David says, I appreciate all the free knowledge on selling puts. Thank you, brother. Appreciate you appreciating that. There's tons of free information. Somebody put a comment, and I would say 99% of my community is amazing in here. Somebody put a comment yesterday, because I always get like that, maybe one out of the bunch or something. And he said, you just want people to buy your product or buy your service. Well, I mean, first of all, that's how business operates, number one. Number two, there's value in working one-on-one, and there's like tons of value, overwhelming value to this app. Number two, and number three, I do provide tons and oodles of free content, like these live streams and like videos, and every so often I do free live events. So yeah, that's kind of funny, but thank you, David. I appreciate you saying that. And thank you for the hearts also. I love when you guys send me the hearts as I'm talking. I love seeing that. Jot, what's your thoughts on RGTI? I haven't looked at that in a while. Let's see. I forget what that is. RGTI. I have traded that a long time ago, because I don't know. I had some YouTube people that were talking about it, and I was like just throwing some trades in. I mean, I would look here first. So like, RGTI. Let me look at it here in my Thinkorswim, just to kind of look at a chart. Although I can look at charts in my app as well. Up a lot, down a bit, kind of sideways. I don't know a lot about it. Let's see. I'm gonna choose next Friday, because today's Thursday already. I'm gonna start with like middle of the road, and I always look at like annualized, rate of return. When is their earnings? RGTI earnings, August 11th. So actually, maybe we can see something here in the earnings. Although I think I have this set for 2 weeks out. I might change that at some point. So we can look at it here. So August 11th is earnings. 6 times it's gone up, 11 times it's gone down. So I would say it's probably not the proper time to let's say sell a put now. I like this to be the opposite, more times up than down. So yeah, hopefully, I'm not sure if that provides the info that you were looking for. Dwayne says, what has been your experience with selling puts and covered calls around earnings dates? Oh, another related question. You might have typed this as I was talking already. Do you prefer before or after earnings date, or stay away until the dust settles? Intel. Today is AMC. AMC old school. I used to trade. That was like one of the meme stocks, AMC, along with like, what was that other one? GameStop, actually. Yeah, I don't know. I mean, I think you asked this question after I already talked about earnings. I think earnings time is a great time. I mean, maybe if you're new, perhaps stay away from it, because it does have a lot of volatility, and sometimes you want to get your feet wet. You want to learn to walk before you run. But I personally like earnings because I like to get paid a premium. I like to get paid more money than what I should be getting paid. Because I mean, who doesn't like that, right? ET phone home. I think it's best to exit a trade before end of day, before earnings. It will always depend upon what the masses think. Yeah, so that's a good. I like your comments, by the way. You have a lot of good, valuable input, and I appreciate you being here in the community. That's spot on. So I mean, exiting the trade, particularly like when you can like realize a gain, is never a bad thing. So yeah, you can always do that. Earnings are interesting because Tesla had earnings yesterday after the bell or something, and their revenue was good, but I think their profit was not as good. And Tesla is a perfect example of this. Like oftentimes they have amazing or favorable, we'll say, I wouldn't say it was amazing yesterday, but favorable earnings. And then the stock goes down because you're right, ET phone home. It's like depends on what the masses think. So the masses, like a lot of people go in and rush and let's say sell and push that stock down. But it will come back up. But yeah, that's a good point to exit a trade perhaps before. So you take the volatility and take the risk off the table. Listen, it's all about like capitalizing on small like realized gains over and over and over and over again. It's like as if you're playing baseball. I'm not gonna swing for a home run, and swing at all these balls that maybe aren't my pitch, that kind of thing. But I'm just gonna like hit a single over and over and over again, and I'm gonna win the game. Life is a marathon, not a sprint. Like a lot of these things I say over and over again, and they're so accurate. Michael Corey says, great work again. Thank you. Appreciate that. Yeah, cool. Joyce says, on earnings edge, what does the IM percent mean? Let's see. Where did you see IM percent? Let me run a scan and see where that is. Let's see. AXP, what is that? American Express, I think. I'll just pick anything. Boeing. BA. IM. Oh, so implied move. So the implied move is a mathematical, it's calculated mathematically based on the pricing of the option. And it's a number, and if you hover over the tooltips, it kind of gives you a little bit more information. It's like what percent does the market anticipate the stock to go? So the market is anticipating Boeing to either go up 6.25% or down 6.25% as a result of earnings. Historically, it's only gone up or down about 1.77, which is good. So the volatility edge is positive. Anytime this is green, that's good. Green is good generally, because the market is anticipating a bigger move than what it historically does, and ultimately that just gives you more income, more premium for the risk that you're taking. Yeah. Win says, I have $5,000 paper losses trading Tesla, selling puts today. Yeah, that happens. I mean, we don't only make money and our stocks don't always go up, and sometimes they go down. Tesla gapped, 11% on the open this morning. That happens, not just to, one stock, or it happens all the time to lots of different stocks. That's why the most important thing is number one, make sure you choose a ticker that you believe in, right? So like me, I've been trading Tesla's long been like my strongest ticker ever. And the reason for that is because of a few different things. Number one, I like the volatility. It goes up and goes down, so when you have a volatile stock, even if I have to buy it, I'm very comfortable that I can sell a covered call against those shares because it's got those pops as well, number one. Number two, always important for me is who's running the show. And so like with Tesla, as an example, Elon Musk is running the show, right? And I find him to be a significantly intelligent, genius-like individual and strong in business. So that's important for me when I'm choosing a stock. And also, like, what does a company do? Like Tesla represents, using, solar, for good things, right? Like electric vehicles. I mean, I think those are good. It's for a couple of reasons. I think Earth-wise, I think it's good, and it helps the planet. Number one, price-wise, it certainly helps. Like price-wise, like I drive a 911. I got gas yesterday. It was like, and I'm in Los Angeles. I use Gas Buddy on my phone because I got so tired of paying like $100 to fill my tank. I think I paid $85 yesterday to fill my tank, right? And my son, he drives a Porsche as well, but he drives a Taycan, so it's electric. So a Porsche Taycan. And when he bought it, he doesn't even have to pay for charging. So he gets to charge like, I don't know the details, like every day up to 30 minutes or something like that. So he pays zero. So, and he drives a lot. So he drives all over the place for business, and he pays nothing. And I pay, $100, not $80 to fill my car. And so like fundamentally from a product standpoint, I think electric, I'm a big believer in solar. My son owns a solar company. I mean, who shouldn't have, everybody should have solar. Oh my gosh, the sun is free. And oftentimes you can put a solar project on your house, and there's all these like government rebates and different things available. And ultimately you pay less money to the electric company. Like, who wants to overpay to the electric company? I could spend that money on something else. So I'm a big believer in that, alternative energy. I'll say it like that. So that's kind of how I look at things. I'm talking about the ticker, so make sure the ticker is good. And then number two, what a lot of people don't do is make sure you got enough money for it. Right? So you don't want to tie up all your money in one trade. So many times I see people selling, 5 contracts of this, and that's like, I don't know, a bulk of their account. No, don't do that. You got to do what fits your account, and also keep money on the side to sell another put. Let's look at Tesla, for example. So let's look at it here as an example. This is a really great, example. So it was 375, now it's 317. So look at it dropped. So first of all, you got this gap, right? So a gap in the chart is when it opens lower than where it previously closed. Gaps will typically fill. So this will go back up. And plus this Tesla will go back up. When? I have no idea, but it will at some point soon. And how about, look at the logic behind, man, if I like that stock at 375, man, I like it at 316 even more because it's on sale. It's like, I'm going to go buy my car and it was like 150 when I bought it or something like that. Would I prefer to buy it at 150, or would I prefer it if they had a sale and I bought it at 120? Man, I would prefer to buy it at 120 because it's the same car, right? It's the same thing. It's so funny, like people just, for some reason, they don't use the right kind of logic. And let's look at Tesla. Okay, let's take a look. And then I'm just going to do maybe, I don't know if I have time for a couple more questions. 12:42. Tesla's got expirations 3 days a week generally. So let's look at, I don't know, next Friday, just as an example. And let's say I want to go middle of the road, and Tesla is 316 right now. I could sell a $300 put. It's got to come down another 5% in the next week. Dude, it already came down like 13% today. It's got to come down another 5 to require me to buy those shares. It's paying $350. I got to put up 30 grand. If I put up all the money, I can use margin, by the way, not even put up all that money. That's the content for another video. And I'm making 50% on my money every year. So yeah, let's see. Hope that helps. Looking forward to the following months. Richard, cool. Welcome to the channel, Richard. Make sure you guys are subscribed. I think I have a requirement anyway. If you're putting a comment on here, you have to be subscribed. SpaceX launch this evening, CST. Oh, I didn't even know that. I never watch the news, ever. I never watch the news, and I'm not on social media other than my YouTube channel at all. So yeah, thanks for filling me in on that. Okay, cool. I am going to jet now. It's 12:43. Man, I hope this helps. I think these sessions are amazing. Listen, when I was starting to trade, and I'm not saying this because I'm biased, I literally wish that there was somebody like me talking for free, like I'm talking to you for free, or able to work with somebody like in a one-on-one mentorship like I do. I wouldn't have made a lot of the mistakes that I made. I always say you could pay a mentor or you could pay the market 2 times as much. That's kind of how I look at it. So yeah, anyway, if you don't have the app, man, get the app. I brought back a 7-day free trial. Try it out for free 7 days if you never tried it before. If you did try it already, you can't get a second trial for free. You got to pay for it. $100 a month, $129 a month. I went up recently, but not for old school subscribers. If you're already subscribed, your price is not changing. And if you want better support, like one-on-one support, reach out, because I have a mentorship program. I only work with a handful of people, and I like it like that, and I'm kind of particular about that. I mean, there's only so much time in a day anyway, and I'm spending all my time building enhancements to this app. It's off the hook. So anyway, enough of that. I hope this content helps, and come back tomorrow. Tomorrow's Friday. Fridays and Mondays are the best days in the market, and we'll see what's going on. Thanks for watching, and happy trading.